dive. So here's an example of kind of how we show our data, and I'll walk you through not just what you're looking at, but how to read it. So this is what we call, a market dashboard, and the numbers that you're seeing there are the Swami scores. And just as a refresher, the Swami score is a kind of a one-stop shop number that ranges from negative 100, which would be really, really bearish or really bad, all the way to positive 100. So a rough rule of thumb would be a negative score is bad and would roughly correlate with something that's in a bearish downtrend. And then a positive score, anything above 0, would be something that's positive and in a bullish uptrend. And that's not a hard line in the sand where you definitely want to sell anything that goes below 0, and you definitely want to hold something that's staying above 0 or buy it with both fists. But that's kind of a rough approximation of how we can quantify what we're looking at. And the two ways that score certainly helps us and hopefully helps anyone that is looking at our stuff. Number one is what we're not trying to do is predict what will be. I mean, that kind of happens as a consequence, which is great. That's what everyone wants to do in markets, is to see what's coming and be able to be in the right assets. But what we're really trying to do with that score is remove the bias to help you see what is, right? So if you have a bearish view on the stock market because of one narrative or another, and maybe it's not just a narrative, it's something more concrete, like monetary policy, the Fed tightening, et cetera. It's okay to have that view, but the score is going to gut check you on that and say, well, yeah, maybe there's a lot of bearishness out there, or there's a reason to believe that the market's going to go down over the next 3 to 6 months. But the here and now, and this is again looking back, not just currently, but also over the last 6 months, where we really saw that Swami score change. Equities are a place to be, or at least they have been, and they still are currently, and they have been for the last 6 months. And our score was kind of picking that up. So it was bearish for a good chunk of last year, and we saw that kind of change pretty considerably, not just in like the SPY, but in a lot of assets, all the way back in March. And if you've been following the weekly wraps and the writing that we've been putting out there, you'll see that our tune kind of changed considerably around March and has been, more a buy the dip mentality over the last 6 months. And sure, that could change. That could change at the close today. It's going to depend on on where that score goes. But that's the first of two things that we're definitely trying to do for ourselves and our trading and our PAs, but also for you. The second thing, and this is I think game changing for me and is for a lot of people, the feedback that I get, is the rank ordering. So what you're seeing here over on the left, where you see the 5 big asset classes, we use the 4 big ones in crypto, which has kind of become its own thing. So commodities, currencies, bonds, aka fixed income, equities, and crypto, and rank ordering them. So you're not just seeing 5 in the same order or alphabetical order over on the left. That order is going to change. So commodities right now are, their strength is 18, and that's just an amalgamation. That's every commodity in our little universe that we track. If you average them together, which of course is not telling you a whole heck of a lot, is averaging 18. Then if you look under the hood at the components of that, well, what's really driving that positive score right now? Energy, for sure. And we're going to get into that. Then you've got currencies, which is of course being driven by the dollar. Bonds, actually, they've been trashed for a while, and we've been ragging on them quite a bit. You're actually seeing an uptick in that score, largely being driven by the riskier side of that curve, junk bonds, high yield, et cetera. Then you've got equities, and then at the bottom you've got crypto, and I'll get into that too. That's kind of been a head fake for us. But that, just to look at this dashboard once a week, Sunday night, and see something like this is really illuminating for us. And then what you see in that middle column and the rightmost column, where you see U.S. sectors here and then factor exposures, is that's really taking what you're seeing in this, under the hood within this equity component, and blowing it out and saying like, okay, well, of U.S. equities, where is that strength? That strength is in energy. And this feels like, if you look at prices today, literally today, it feels like an obvious, oh yeah, of course, XLE and XOP are breaking out to new recent highs. But if you've been following us for a while, you know that energy and housing have been at the top of the list for quite a long time. But by quite a long time, I mean, totally checking on it. At least 2 months, you've seen those two at or near the top of this list.
That's right.
Utilities is another one where you would think theoretically utilities would do well in sort of this constrained growth or inflationary environment that we've seen, and they were doing well for a while. Then the score dropped off a cliff, and now utilities have been, for almost that same amount of time, at the bottom of the list. So I may have a bias. I love utilities personally. I've been long them quite a bit. I have a bias where it feels like this is a time where I should be long utilities, but I look at the score and I say, absolutely not. I'm not even going to entertain getting long XLU. I'm going to look at XLE, even though that feels, I hate being long energy just because I can't trade it as well as I can utilities. But this is gut checking me against my own biases. So that's why we find, this setup really useful for us, personally, and hopefully for our subscribers as well.